If you've spent any time learning about investing, you've probably come across terms like index funds, ETFs, mutual funds, and hedge funds. They're mentioned everywhere. Financial news talks about them, investors debate them, and social media is full of people recommending one over another. The problem is that many beginners hear these terms repeatedly without ever getting a clear explanation of what makes them different. At first glance, they seem to serve the same purpose. You put money in, the money gets invested, and hopefully it grows over time. But beneath the surface, these investment products can work very differently. Some are designed to simply follow the market, others try to outperform it. Some are built for everyday investors, others are intended for wealthy individuals and large institutions. And depending on which one you choose, the fees, risks, flexibility, and long-term outcomes can vary quite a bit. So in this video, we're going to break everything down in simple terms. We'll look at how each type of fund works, how it's managed, how it's traded, what it costs, and who it's designed for. By the end, you'll have a much clearer understanding of the major investment fund types and why they exist. And as always, this video is for educational purposes only and should not be considered financial advice. Let's begin with a simple question. What exactly is a fund? Imagine a group of neighbors wants to build a community garden. Instead of each person buying land, tools, seeds, and supplies on their own, everyone contributes a small amount of money into a shared project. By combining resources, they can build something much larger and more efficient than any one person could create alone. Investment funds work in much the same way. Rather than investing separately, thousands or even millions of people contribute money into a shared pool. That pool of money is then used to purchase a collection of investments. Those investments might include stocks, bonds, real estate assets, commodities, or other financial instruments. When you invest in a fund, you're essentially purchasing a small ownership stake in that larger portfolio. As the value of the investments inside the fund rises or falls, the value of your investment changes as well. One of the biggest advantages of this approach is diversification. Instead of depending on a single company or a single investment, your money is spread across many different assets. That can help reduce the impact that any one investment has on your overall portfolio. Now, not all funds operate the same way. The biggest differences usually come down to four things: how they're managed, how they're traded, the strategies they use, and how much they cost. Once you understand those four factors, the differences between index funds, mutual funds, hedge funds, and ETFs become much easier to understand. Let's start with one of the most popular investment products in the world, index funds. Over the past few decades, index funds have become the foundation of many long-term investment strategies. Their popularity comes from a surprisingly simple idea. Instead of trying to identify the next winning stock, why not simply own a small piece of the market as a whole? To understand that idea, we first need to understand what an index actually is. Think of an index as a scoreboard. Its purpose is to measure the performance of a particular section of the market. One of the most famous examples is the S&P 500. This index tracks hundreds of large companies operating across many industries in the United States. When people say the market had a good day or a bad day, they're often referring to indexes like this one. But there are many different indexes. Some focus on technology companies, others focus on small businesses, some track international markets, and others focus on specific industries, such as healthcare, energy, or finance. An index fund simply attempts to mirror one of these indexes. If the index owns certain companies in certain proportions, the fund attempts to own those same companies in roughly the same proportions. The goal isn't to beat the market, the goal is to match the market. If the index rises, the fund rises. If the index falls, the fund falls. Because there isn't a team constantly researching opportunities or trying to predict market movements, index funds are generally inexpensive to operate. That often translates into lower fees for investors. And while low fees may not sound exciting, they can make a surprisingly large difference over long periods of time. Another reason investors like index funds is diversification. Many index funds hold hundreds or even thousands of individual investments. That means your portfolio isn't dependent on the success of a single company. If one company struggles, its impact on the overall fund is usually limited. Of course, index funds are not risk-free. If the broader market experiences a significant decline, index funds will generally decline as well. But because they're spread across many investments, they're often considered less risky than owning a handful of individual stocks. There's also an important detail many beginners don't realize. Traditional index funds don't trade throughout the day like stocks. Instead, they're priced once per day after the market closes. If you place an order during the day, your transaction is usually processed later using the fund's end-of-day value. For long-term investors, this generally isn't a major issue, but it's an important distinction because not every fund works this way.
Take mutual funds, for example. At first glance, mutual funds can look very similar to index funds. Both pool money from large groups of investors, both provide diversification, and both can hold large collections of investments. But the philosophy behind them is often very different. Most mutual funds are actively managed. Instead of simply following an index, professional managers make decisions about what to buy, what to sell, and when to make those changes. Their goal is usually to outperform the market. They analyze companies, study industries, monitor economic trends, and search for opportunities they believe can generate better returns. In theory, that sounds like a great idea. After all, if experienced professionals are making investment decisions on your behalf, shouldn't they be able to outperform a passive strategy? The challenge is that financial markets are incredibly competitive. Every day, thousands of professionals are trying to identify the same opportunities. As a result, consistently outperforming the market is much harder than many people expect. In fact, many studies have shown that a large percentage of actively managed funds struggle to outperform comparable index funds over long periods once fees are taken into account. And fees are one of the biggest differences between mutual funds and index funds. Because active management requires research teams, analysts, and ongoing trading activity, operating costs tend to be higher. Those costs are ultimately passed on to investors. That doesn't mean mutual funds are necessarily a bad choice. Some investors prefer them because they want exposure to specialized sectors or unique investment strategies. Others believe a particular manager has demonstrated exceptional skill. The important thing to understand is that mutual funds place a greater emphasis on human decision-making. Whether that creates better results depends on the manager, the strategy, and the market environment. Like traditional index funds, most mutual funds are also priced once per day after the market closes. Now let's move into a category that operates very differently from everything we've discussed so far: hedge funds. If index funds are built around simplicity, hedge funds often embrace complexity. Hedge funds are private investment pools that typically accept money from wealthy individuals, institutions, pension funds, and other large investors. Unlike traditional funds, hedge fund managers usually have far greater flexibility in how they invest. They can buy stocks, sell stock short, trade currencies, invest in commodities, purchase real estate, use derivatives, and employ sophisticated strategies that most retail investors never encounter. The goal is often straightforward: generate strong returns regardless of whether markets are rising or falling. To pursue those returns, hedge funds frequently use leverage. Leverage involves borrowing money to increase the size of investments. While leverage can magnify gains, it can also magnify losses. That means hedge funds often involve higher levels of risk than traditional index funds or mutual funds. Because of those risks, hedge funds are usually limited to accredited investors and institutions that meet specific financial requirements. The fee structure can also be very different. Historically, many hedge funds have used what is known as the 2 and 20 model. Investors pay an annual management fee equal to 2% of assets under management, plus 20% of any profits generated by the fund. Compared with the relatively low fees associated with index funds, that's a substantial difference. Supporters argue that exceptional hedge fund managers can justify those fees through superior performance. Critics argue that consistently delivering superior performance is far more difficult than it sounds. Regardless of where you stand on that debate, hedge funds occupy a very different part of the investment world than the products used by most everyday investors. That brings us to ETFs. Over the last 2 decades, ETFs have become one of the fastest growing investment products in the world, and it's not difficult to understand why. ETFs combine characteristics of both traditional funds and individual stocks. Like index funds, many ETFs provide diversification by holding large baskets of investments. But unlike traditional index funds, ETFs trade throughout the day on stock exchanges. That means investors can buy and sell them whenever markets are open. Prices update continuously in real time. This flexibility is one of the biggest advantages ETFs offer. If market conditions change, investors can react immediately rather than waiting until the end of the trading day. Many ETFs are also relatively inexpensive. Like index funds, many simply track indexes and therefore require less active management. As a result, operating costs tend to remain low. Another reason ETFs have become so popular is variety. Today, there are ETFs focused on almost every area of investing imaginable: technology, healthcare, energy, artificial intelligence, dividend-paying companies, international markets, government bonds, commodities, and much more. No matter what area of the market interests you, there's a good chance an ETF exists for it. In many cases, investors can choose between an index fund and an ETF that follow nearly identical benchmarks. The main difference often comes down to trading flexibility and personal preference. So what does all of this mean for the average investor? The answer depends on your goals, your risk tolerance, and how involved you want to be in the investment process. Index funds are popular because they offer simplicity, diversification, and low costs. Mutual funds appeal to investors who believe active management can add value. Hedge funds pursue more aggressive strategies and are generally reserved for wealthy investors and institutions. And ETFs provide a combination of diversification and real-time trading flexibility. Each of these products serves a different purpose, and none of them is automatically the best choice in every situation. The most important thing is understanding what you're investing in before you invest, because once you understand how these products work, you're in a much better position to make informed financial decisions. If you found this video helpful, consider subscribing for more investing and personal finance content. Thanks for watching, and I'll see you in the next video.